Welcome to Worldwide Denver. So we did trademark this. Matt had delved into it a little bit, but the idea of this was to get out and take advantage of the great publicity nationally and worldwide that Denver's now getting. You know, being in the real estate market 30 years, you know, even as recently as 10 years ago, 8 years ago, Denver wasn't really recognized by your large institutional investors that bought in the East Coast and West Coast, and now we are. So you're seeing a lot of activity on the larger properties. They're coming in paying cash, paying 3.5, 4 cap rates, which is a very high price for property. But if you look at it from their viewpoint, when they're coming out of San Francisco or New York, that's kind of normal price range for them. Mm-hmm. So they're driving our prices up. Thank you. So we wanted to take it out. So.
All right, we'll jump right into it. So we always will recommend that you talk to your attorney, your financial advisor, as well as your attorney, financial advisor, before making any investments, because investments do fluctuate. That says a lot more detailed in here, but mainly what you guys know is this for educational purposes only, and we will not be acting as your attorney. So.
Or your accountant.
Or your accountant.
Standard disclaimer.
Standard disclaimer. Keeping it high level.
So, Western Investor Network, who we are. Let's see if I can condense this down. Small boutique brokerage firm, but we're a full-service commercial brokerage firm. So we can do anything. Somebody walks in the door, wants to do some commercial real estate. What I've built and what we're continuing to build is something that can help them do that, whether it's an acquisition, disposition, a tenant representation, a landlord representation. They need money to finance a deal. We do not have a lending arm yet, but we do a lot of hard money lending. We can place private money lending, help deals get closed. We have a Western Management Services. This is our management arm, so we can do commercial property management, and right on down the line to buying non-performing notes and doing other more creative things that we'll get into later. So really a full-service commercial brokerage. If we don't do it in-house, we know where to send you to get it done.
Well said. Well, and so Denver, why Denver? With all the things happening in Denver, with a lot of people moving here, if you click on to the next slide, you'll see.
We're here already, right?
Yeah, we're already here. So, but you have world-class sports, 4 seasons of world-class sports everywhere from mountain biking to hiking to skiing and snowboarding in the mountains. Really encompasses it all. Could be one of the many reasons why a lot of people are moving here is just because of the outdoor activity. Mm-hmm. And so some of the other things that kind of makes us unique is we do have essentially every sports team, professional sports team possible. From men and women's NBA basketball all the way down to we have rugby teams and lacrosse, indoor and outdoor lacrosse. So really provides a wide variety of the sports as well as the outdoor activity. And we definitely can't forget that Colorado was one of the first to legalize medical marijuana, and in 2012 they were the first to legalize recreational marijuana. And in the first 8 months of 2017, dispensaries had a revenue of $1.2 billion. So in 8 months, $1.2 billion. That's coming from dispensaries. There's twice as many dispensaries as there are Starbucks. So, I actually read another stat. There's more dispensaries than there are Starbucks and McDonald's combined in the state of Colorado. So, pretty impressive.
That's a lot of marijuana. That's a lot of revenue.
3,000 businesses in 2016. I saw a stat. So at the end of 2016, there were 3,000 marijuana-related businesses in the state of Colorado.
Starbucks will get into that. They will.
You know what? It kind of makes sense.
Yeah.
Caffeine and marijuana. It's a good combination. Right?
Never tried
So
it.
it's grown from a couple states to how many states now?
I think there's 28, I thought.
28. Oh man, it changes every day. I know that.
Well, medical I think is higher, but yeah.
Medical's in the 30s, and I want to say there's and then I know Boston, California, us.
But it's grown fairly rapidly.
Mm-hmm.
So
fairly, definitely an understatement. So
light rail systems. So Denver has a great light rail system, just a few years old, probably 10. That's pretty new in comparison. You look at New York, it's had a transit system for years and years. This has really spurred a lot of development for Denver. Since this came in, you got your Todd projects, transit-oriented developments around most every stop. It's really just blown up. So you're seeing a lot of development, a lot of redevelopment in those areas, and that's going to continue along these lines until it's fully built out, which is going to be years. So it's a great opportunity, and it's a great way to get to the airport. So
And I mean, the city, the municipality, they're preparing for extreme growth, as we've seen. And the way they're putting these light rails in all the way from the airport, eventually out to the mountains, they're planning on a lot of growth. And I'm very confident that Colorado is going to continue to put infrastructure in place to support that growth. So that if we do end up being a Boston or a New York or a LA.
And a lot of your large institutional investors, like I mentioned earlier, this probably keyed them a little bit because they look for things like this when they go in to invest. Not just the rapid growth, but the transit system. That's really going to cut down on the traffic. So that's a few things that make Denver unique. Here's a few of the unique projects. So the Cinderella City Mall development. Those of you that have been around as long as I have, or a pretty long time, will remember this. 1991. That was redeveloped into one of the first mixed-use property in the country. That's apartments with retail combination. Prior to that, institutional or large lenders, large banks, wouldn't loan on that type of project. They didn't think it viable. They didn't think it would go. These guys somehow put a business plan together that got a lender to finance it, and it took off like wildfire, and it's grown across the country. As a matter of fact, now when you go to put a development in a major corridor, the municipality that you are in is more than likely going to ask you or require you to have some type of a retail component. And they do that because they figured out that they make more money. They get higher tax revenue from retail than they do from residential. So it just took off like wildfire. But that's very unique to Denver. We kind of started the ball rolling on that.
Do you think they want more specific retails in there, like more of a clothing store, more of a food or bar? Have you seen
Municipalities, I think that probably varies between the municipality. Everyone's probably going to be a little bit different on what they like to see in there, but
Right.
they won't be shy about telling you.
Gotcha.
When you come to them with the development and say, we're going to build this,
Yeah.
they'll let you know what they'd like.
Yeah, and one thing we always talk about is they're gonna find a business that is service oriented because of the e-commerce and being able to buy everything online. Now, if you're gonna have something underneath you, it's gotta obviously make sense. So we do hear a lot of that.
And it needs to tie in probably too. Like one of the things that made the Cinderella City Mall redevelopment was it was on the light rail station right down there at Hamden and Santa Fe, so they could get on light rail, go downtown. But the retail that was underneath it, it was kind of a one-stop shop. So they could come out of their apartment, pretty much do anything they wanted, shopping-wise right there, get on the light rail, didn't have to have a car,
That's great.
go to work, come home, go to work, come home, didn't have to go anywhere. That's one of the main reasons that just took off. So Denver International Airport, another huge project that put Denver on the map, very unique, obviously, it's in Denver, but 18th busiest airport in the world now, 6th in the United States. And it's the largest in the United States by area. So we've got more acreage out there to build on and develop and expand into than any other airport in the country. And it is Colorado's largest employer at this point in time.
Yeah.
Stapleton Airport redevelopment, another unique project for Denver. That's obviously the old airport. DIA shut that down. That redevelopment is to date, I believe it's still, at the time it definitely was the largest redevelopment project in the country for years. And I think it's built out now, but there may be a little bit of ground left north of I-70 where the runway used to go over I-70, and I think there's some ground up there that still would need to be built out. That's a rapidly growing, great project for Denver and put Denver on the map as well.
Construction project in the U.S. right now. That along with close to the same area along the I-70 corridor, the National Western Stock Show, which is the largest in the world. Those are two big projects that are being worked on right now. I believe the Gaylord Rockies Hotel is slated to open at the end of 2019. and it's already being booked out. So
It has a huge convention center component to it as well that makes it the largest. So you've got your hotel convention center.
yeah, and the reason we're bringing this up is to just kind of highlight. I mean, we could go through and talk about projects all day. Hence why we're here. But you have a lot of money from out of state coming into Denver. You have a lot of institutional money to the scale of 141 million in Cherry Creek, which was fairly recent, and then a Miami firm came in and bought a $32 million office building in the tech center. You have money from Singapore, who bought an office park for 117 million, and then I'm sure a lot of us have heard about Google coming into Boulder and in Q3. And I think I just read another one. It was 3 total industrial buildings, 2 in Denver, 1 in Golden, that sold for 51 million, and I believe it was about 500,000 square feet total.
Yeah, that's very recent, just in the last
Like-
month. That just came out and was announced. It's a portfolio of 3 properties.
Yeah, a company out of
Big
Chicago.
sales. We could go on with several slides of large sales like this with these institutional investors, but this just kind of confirms and parlays the point that we were making. So
Yeah.
Denver's a hot market. So I imagine any of these cities could find a way to rank themselves as number 1 under something, but Denver is 1, 2, 3, 4, 5 in most of the studies that you're going to be able to find out just because of what it says here. Job growth, construction, economic expansion, office and retail components. Our industrial market, we'll talk about in just a second, I think is just been on fire for the last 12 years. So national recognition, when you get this type of a ranking, you get noticed around the country and around the world.
All right, and so here's some data we were able to pull, and I'm going to go ahead and just highlight these 2 slides here on the left first. If you see the cap rate, what this is purchases in Denver over the last 5 years across the board of all commercial real estate, and it shows you that purchases used to happen between a 7 and an 8 cap, and a cap meaning your capitalization rate, what you're going to yield on a purchase. Right now, you're averaging below a 5% yield, below a 5% cap rate. Could be because where's this money coming from? Everything's getting more expensive, supply, demand. Around here you see private money at 58%. If we would have looked at this 5 years ago, this green right here, this institutional money, the REIT, the blue, these would have been a lot smaller. We're seeing a lot of these right now in the last 5 years. 25% of the purchases are coming from institutional money. So before 5 years, that number would have been a lot smaller. And what we're seeing because of that, the sales volume is going up here in millions, and so is the price per square foot. And we're looking at, and this is across all of Denver, not just downtown, you're looking at prices upwards of $250 a square foot.
Direct investing in Denver today. So it's kind of what we wanted to base this on is a direct investing versus the indirect investing, which we're going to talk about in a little bit. So the type of investment, stocks, CDs, securities, everybody knows what those are. That's anytime you go to a stockbroker, go and invest your money, that's what they're going to tell you to do. You can do some direct lending, direct real estate investing. You just go out and buy a house, rent it out, go out and buy an apartment building, rent it out, shopping center, rent it out, manage it. Denver is a fairly newly recognized investment sector, and that's kind of what we've been talking about with the institutional investors, that it's, just the last few years that we've really been recognized with a lot of high dollar investors. Residential properties have appreciated for the last 12 years. That's apartments and houses combined. That's a pretty good run-up, very good run-up. Increasing activity in the market / the supply. Created demand, drove up rents, and increased values on residential and commercial properties across the marketplace. So that really confirms or is confirming what we've already kind of talked about, that the market is just very hot. There's very few properties out there to look at, and the ones that are out there are priced at a premium.
Yeah.
Glad the intern.
There we go. A little technical difficulty.
Quick question, if they're allowed.
Yeah,
Yeah.
absolutely. Yeah.
Please, anybody has a question, jump in.
Has there been any pattern that you've recognized on the national investors or type of product where there's hovering around cap rates that you can be happy about, or
As a buyer or a seller?
as a buyer?
Yeah.
Buyer says, I want to go to Denver, but I've got to have some sort of return on my investment, et cetera, et cetera. Are there any
I think your
numbers?
question would be, what's the best sector to purchase in right now? What would provide you the best return?
Yeah.
I,
Cannabis was my answer, but
that's a more of a business, right?
it's more of a business, more of a risk, more of a brand new industry. But in terms of just in terms of return, you are investing more in the business. So I'm not sure that that's probably the answer you're looking for.
Yeah. So for me, I'm going to say I would go with industrial. I think industrial has it's got 29 consecutive quarters of growth, but I think you're still going to see that. Part of it is the marijuana business. I think you can tie that 29 quarters into the last, what is that? You figure that 7 years or so that the marijuana industry has really taken off. But I think you can still garner some good returns and some fairly priced properties there. Retail, I think, would be next for me, then office, and then into the multifamily sector.
Okay.
If you're looking at the bell curve, you know, I think multifamily, man, it's got to be up there at the top. Retail's probably a little farther down. Office didn't really recover as much as it probably as the other sectors did from the last downturn. So there might be some appreciation there, but the vacancy's back up at about 11.5% right now. So I would say industrial would be my #1 pick, followed by retail.
I think that would be, with the growth going on, with all the buildings, people needing more HVAC, steel and all that stuff to build all this. So the industrial, I would agree with that.
Especially since a lot of your, say, the Source or a lot of these buildings, like the Stanley Market, that was maybe considered an industrial building at one time before they built it out for offices, shared workspace, things like that. And then with the marijuana, as we mentioned, creating that supply, or maybe that demand, even that maybe artificial demand, because there were only so many licenses that were available for purchase to tie to only so many properties in that zoning. Therefore, there was an artificial demand created, which inflated prices, and a lot of people were paying high rents, and people were seeing a lot of high returns, industrial too. Now that there's moratoriums, I'm not sure how long that's going to last. We're going to find out.
And Source, as he mentioned, it's not all marijuana. I mean, that's an industrial property that was turned into a retail mixed-use kind of a component. If you look all up and down the Brighton corridor, you can see that every other property is an industrial property that's being repurposed or redeveloped into some type of a retail or mixed use, or scraped and apartments being built. So as those get pulled off the market, not only does marijuana occupy them and use them, they get scraped and taken away. So newer product needs to be built, which is much more expensive.
And let's really highlight that real fast for people that are watching around the world. The Source is I guess you have the Source, you have the Stanley Market. They're all shared workspaces that incorporate retail, office.
The Source has a restaurant, it has a meat market, it has a bank in it. You name it. It's a component of. They arrange these properties with like properties that would have equal or equal synergies and could all work together, as opposed to having 2 nail salons in the same place. They were not going to cannibalize that. They were just going to go with businesses that would be in equal synergy with the rest of the tenants. And that's what made it a pretty viable project. So they had built the Source. They were throwing out names to people.
The Rock Drill. The Rock Drill is a big project coming up in Rhino. I guess it would be like the East Rhino. The Rock Drill, but there's a list of projects that are being worked on. But the Source was one of the first. That's why I refer to it as kind of innovative in a sense of what we saw in Cinderella City, where they were taking an apartment and then putting retail. Now they're just taking that to the next level. Is what we're seeing a lot.
The Source exploded, very popular, very. And so you're seeing a lot of those projects pop up as well.
Yeah.
So,
They just built that parking lot right next to it too.
Yeah, they're putting
they
a
needed
hotel
to.
as
Their
well.
parking lot was awful. There were a pair of shoes in that parking lot.
I own the doggy daycare across the street, so I know that.
Yeah, it's got it all. Yeah, and they're actually building. I did a tour just recently, and I think it's 6 stories or at least 6 floors, but it's a hotel with, guess what, retail underneath, and it's a luxury hotel. But it's gonna be very unique. It's gonna be very unique. So we'll see how that all turns out.
And the list of projects goes on because there's a number of them on the drawing board.
Yeah. So I think we're on. Yeah.
On with the direct investing. So here's the industrial category: 29 consecutive quarters of absorption. It's awesome. I don't know that that's matched.
I would say 29 consecutive quarters. That's about 7 years. It's 2018 now, and marijuana became legal medically in 2009, recreationally in 2012. So kind of makes sense where this absorption might be coming from in the industrial sector. Kind of what we just touched on. Didn't mean to interrupt you there.
That's all right.
Yeah.
This is it's a meetup group.
Yeah, I know.
Oh, you can talk too.
I'm excited to hear about the indirect investing. I wanted to talk about this next slide coming up after this, but I'm gonna let Tony do it because.
So direct investors in your stock, especially in the stock market right now, I think are getting a little concerned that it's approaching a high. Who knows if it is or not? I don't have that crystal ball, but it probably has several quarters of consecutive growth as well, as we all know. So they're looking to do some diversification of their portfolios into real estate or other assets. With direct investing, there's a lot of management involved. So if you did buy that house, you got to manage it. You got to take that call at 10 at night when the furnace doesn't work or whatever may be the problem. So out of direct investing, these are the opportunities that are presented. So it isn't for everyone. Direct investing, you got tenants, toilets, and trash is kind of a carry on from the last slide. Indirect investing can be an investment fund. So you would invest $1 million in this fund, 500,000, 100,000. Some of them have lower end limits. And they would invest your money in real estate, or we're actually looking at an opportunity fund coming up, but they can be various funds doing various different things. You can go out there and pick one that does something that suits what you want to be investing in. Mutual funds, everybody I think knows what those are. Stocks, bonds, combination of those. REITs, real estate investment trusts. Similar to the same thing, they typically invest in one product type. So malls or multifamily or retail. Rarely do they mix, but sometimes they do. TIC and DST, tenant in common, and Delaware Statutory Trust, pretty similar products. Before the last downturn, I think most people will remember the TICs. Anybody that was over leveraged in their TIC got hurt, and so some people did lose some money, and that's why investors will remember that. Delaware Statutory Trust kind of came out after the recession. They changed the way that they do business a little bit, so it's similar but not exactly the same, and that is the same type of component. So you could take your 100,000 or $1 million, put it into a large office building in Miami. They manage it, run it, pay the management company, do all that, and then they provide you with a return, usually in the 6 to 8% range right now. Syndication, which we do some syndication. That's just basically putting a group of like-minded investors together to invest in something. So if all of us wanted to invest in office, or if us four wanted to, and us four wanted to go into retail, we would form a small syndication and go out and do that.
And so one thing that all of these things have in common that might be different than what he's gonna go into here next is just the lack of control, maybe, on your part, hence the indirect investing. But there are some ways to indirect invest where you do have more control as well, which I am excited about. So
Right. So performing note is kind of, basically you would go out and buy a note that's already existing. So you wouldn't make a loan to that investor, but Bob has already made that loan, but he wants to sell it. It's performing, the borrower is paying, but he wants to sell it. Maybe he'll discount a little bit, so it'll increase your return. You would buy a performing note. Non-performing note, done several of these lately myself. I love this product. It's a little challenging, but the way we look into it and do it, we'll talk about a little bit later, but basically you're buying a defaulted note, so the borrower is not paying on that property. A lot of people think that that's just a totally bad thing, but you have a collateralization on that, and we'll talk about that a little bit later, but it can be a very profitable investment with very little risk that really the market perceives it as having a much higher risk than we believe it is. Professionally managed real estate, so you could buy that house and then put it in a manager's hands, or that real estate apartment building or retail product and put it in a property manager's hands like we do on a retail side, and we're going to charge a fee for that, and so will that property manager that does the house. So you're going to give up a portion of your income and part of the control. You know, you're going to be controlling that manager, but you know they're going to be doing the work, so you're going to give up part of that work. Indirect investing is a very solid path. You can leave your management behind and still get a good return on your investment. So a little deeper into syndications. I think we talked about that already. Small investors owning larger properties. So the syndication, you know, Gleb couldn't go out and buy that $1.5 million property on his own, but the four of us could. We all put a little bit together, get a 70% loan to value, pretty standard leverage on that type of product, and buy that property and operate it. Like-minded investors. So again, you're like-minded, you're going to want to invest in the same thing. So Gleb wanting to invest in an apartment building, going with AJ that wants to invest in a retail project, you know, might butt heads a little bit on some stuff. So it may want to double think that. Think about that twice. Typically a cap rate purchase on syndication. So they're going to go out and pay a market rate for that. A rate of return on retail right now in the Denver market would maybe be a 6.5 to 7, maybe a 7.5, depending on the condition of the property, amount of vacancy, and other factors that would affect the net operating income, which is what you base a cap rate off of. Or you can do a non-traditional investment blend, which we've trademarked as a return accelerator, and we'll talk about that in depth in a little bit. Provides no work or management responsibility for the investor. So the syndication would have one lead guy that would kind of line that all up. Not kind of, would line that all up, set up the management, operate it, and the minority partners would really kind of be hands-off. Equity financing is another indirect way to lend. So you could do hard money lending or private money lending. A lot of people think these are the same. We believe they're different. I'm convinced they are. Hard money lending, which we do out of our office, is perceived to have a greater risk and therefore a higher return. It does provide a higher return, but if it's leveraged properly, typically it would be a 65% loan to value. You got a 35% cushion there. Hard money return expectations are 10 to 15%, which are quite a bit higher than market rates. If you go out to get a house loan right now, you're probably in the 4% range. And then you got 3 to 5 points, which is a basically prepaid interest of 3 to 5%. So you get that when you close your loan. Private money will be a loan to value of 75%. So that's more like friends loaning money to friends, I guess is the best way to put it. It's more of a private money loan. You want to make the loan, but it's not really that risky. You know the person, or you have some other type of a relationship. You'll loan them a little more money. You'll do a 75% loan to value with a 25% equity stake on the borrower's part, and then their return ranges are in the 7 to 10% range right now, and probably in the 2 to 4 points. So you're making a pretty good return on that. If you get a 10 and 4, that's a 14% annualized return. With hard money, you're at maybe 20 on the high end annualized return.
That all makes sense. Any questions on that? Experts already. Joe?
Well, no, I'm not volunteering to be an expert.
No, not at all. No.
Give you 5 minutes. Tie together the hard money loan and the type of product that hard money might be more attracted to as far as a use, whether that would be scratch that use thing. Property management. Hard money, property management, does money move to a type of property management, whatever? It would seem to me that there would be a type of income property that might not be as attractive in one marketplace for another. The money would not flow there. And I'm not going to say that maybe you don't want to do sports stadiums or something else, but I mean, I'm really.
We don't have the kind of money you do, Joe. We can't do a sports stadium.
Well, whatever. Well, let me give you an example in the marketplace. Something I kind of really like, and that is that taking office space dividing it into multiple uses so that you can have your skateboard and your dog and all that sort of stuff, might that be more attractive to a guy who's got money, either on the property management side or the return side or whatever? It's just, or is it just the numbers speak for themselves?
I think with hard money lending, for us, the numbers speak for themselves. So we're going to need to like the story, whatever they're doing. If they're putting a skate park in there so that their employees and millennials can, sorry millennials. Everybody beats up on the millennials. I might as well jump on it anyway. Sorry, intern. The intern. So we're going to want to hear, we're going to want to believe the story. We're going to want to understand it, what they're doing. The property, if that use doesn't work out, can we reposition it or take it back to what it was before? The loan to value, all of the factors, and there's several others need to align for any hard money lender before they're going to do the deal. And if it's a 30% loan to value, those matter much less because they got 70% equity stake. So a lot of factors and a lot of moving targets there, but typically it's a case by case basis. And it's really the investors. We have investors that lend hard money as well as I do, and the company does. And we all have a little bit different tastes in what we would like to do.
Okay.
These are, we had mentioned we're doing some of these. So you source these from financial institutions, private lenders, really anywhere there's a defaulted note, anyone that's made a note and the guy isn't paying for it. I got a friend right now that lent some money and they're not paying them, so he's got a defaulted note.
Yeah, and one thing I do want to point out, why I love when Tony, get to listen to Tony talk about this when he takes the floor, is this is what separates us a lot as well. Being in the Denver market, and Tony's been here investing with him and his partners for over 30 years. They do have these relationships that not a lot of people do, and it takes years to establish those and have access to that. And so that alone right there makes it a little unique that we have access to that here in Denver, and we do source these all across the nation, not just here in Denver.
Yeah, we're definitely not area bound on the product that we look at. And I'll add to that a little bit that during the recession, everybody was going to buy the non-performing notes and the distressed assets. It really didn't materialize, but I think the institutions got kind of upset in all the people that put themselves out there as experts and note buyers, and then they just didn't perform on the product. So who I partner with and our equity partners performed on the deals. So actually we have some of these institutions and some government institutions as well that call us when they have defaulted notes because we have a good history with them. We perform when we say we're going to perform, or if we're not interested in it, we let them know. We walk very quickly. They appreciate that. It saves them time, money. They can conduct their business. So that's key for us in garnering those relationships. We strategically underwrite it, so any non-performing note, you want to strategically underwrite that to make sure that you are covered and that you are eliminating your risk, because you can lose money. Obviously, the guy's not paying, right? Or gal, sorry, guys. Fee simple collateralization. All of the notes that we do, we don't get into equipment financing, that type of stuff. All of ours are fee simple collateralization, which basically means we have a piece of real estate that we can foreclose on and take back to pay our debt if indeed they can't work out their problem. So the next line is debtor negotiation and note term modification. So once we buy that non-performing note, then we will immediately contact the debtor, find out what the problem is. We already pretty much know the story because we've underwritten it. But we want to do a workout with them. We don't want to go in and foreclose on their property. We would like to do a workout with them, let them solve their problem, rewrite the known terms, pull forward the maturity, increase the rate so we're getting a better return, give them 6 months, 8 months, 18, 24 months, 36 months, whatever they need that we can work out and make sense for us. Again, it's the plan, makes sense for us, then we renegotiate that to those terms. And the returns on that can be well above average and typically are. So they're a little higher than the hard money rates that we talked about earlier, but they actually can be significantly higher than that. If you actually take the property back or put it through a foreclosure sale, odds are you probably won't get it. One of you investors will step up and buy that property at the foreclosure sale, but if you do get it back, you can make some pretty good money that way. I actually just did one that we did pretty good on. We did get it back from foreclosure sale. It was a very complicated deal, so most people just stayed away from it.
And yeah, okay. So here is a little bit about why we are different and how we can help. Not to be, to avoid redundancy, Tony kind of explained a little bit. We are a boutique brokerage firm that really has the client's best interest 100% in mind, because we do the one-on-one counseling. We are general. We do not focus on one product type, and we are trying to help the client through the entire cycle of the deal, whether that means they're selling and they need to 1031 into another investment, and we can talk to them about securing a solid long-term investment and then maybe tapping into it if they're okay with a little more risk. When I say tapping into it, kind of tapping into the equity, writing some hard money notes, buying some non-performing notes as well, like Tony just alluded to. And so having the ability to really counsel our clients and understand what our clients need and want is what sets us apart, along with just the fact that, well, and you know what, and mostly besides Worldwide Denver and Tony's experience, as well as his partner's experience and his equity partner's ability to source things, we also have the Return Accelerator, which is kind of the segue into this next slide. And so I'm going to give it back to Tony. A lot of this stuff you guys might be familiar with, but the way we do it and how we structure it is pretty unique to us. So we have trademarked it as well.
Yeah, to follow up on what makes us unique is we've done pretty much everything we're talking about. So we own property, we manage property, we've done everything that we talked about. So it's not like we're up here preaching something that we don't practice. We do this on a daily basis. This is a program that we didn't really invent, but we kind of put it on steroids and trademarked it Return Accelerator. So the best way to explain this is probably go through an example, but it's how we can take an investor's monies and accelerate that to the next level of return. So I'm just going to say Joe buys a $2 million strip center. Let's say the four of you guys buy a $2 million strip center. Y'all put $500,000 in, you pay cash for it. You got a $2 million asset at, let's say it's making a 7% return in this market right now. Okay, so we will tap $1 million of that. Take out 50%. We'll pull that out. Cost of funds on that right now for commercial loans probably 5%. So the other $500,000 still making it 7% return, ticking along just like you bought it for. This $1 million that we're taking out is now really only making 2% return because you're paying 5% to have that cash in your hand. We will then, and let's just use an easy example, hard money loan. We'll take that $1 million and do 1 or 2 or 3 hard money loans. Let's just say we do one at $1 million, and we get our 12% return with 3 points. That's 15% annualized return. So that $1 million is now making 17% as opposed to the 7% that I was making stuck or left in that property. So you can pay the cost of that, bring it out, we can accelerate that return. There'll be costs and fees in there obviously, but that's a pretty good general rule of what the Return Accelerator is and how it can really accelerate your investment return on an asset. It doesn't have to be that you bought one. You could own it already and we can tap your equity. You've owned it for 20 years, you just inherited it from dad and it's free and clear. You want to put that money to work, but you love that property. You don't want to sell it. We can show you how to boost those returns. So it's a very unique product. Yeah, I love it. I love talking about it and I love doing it. So, well, that was it for this webinar. Meetup group combination. Anything to add?
I mean, is there any questions you guys have or anything that we kind of went through quickly that you want us to touch on a little bit? No?
Yeah,
Nothing?
No, might
Not
later.
even that return accelerator? Come on, that's great.
Yeah, I like that.
Yeah.
Anything takes steroids and builds it up.
Don't even have to take steroids.
Yeah, no, it's a good blend of taking a secure investment and then adding a little risk to it. But if you are confident in your ability to underwrite that risk, which we are very confident, then how much more risk are you really taking on in order to increase those returns? Probably not that much. And
It's a win-win situation.
yeah,
Yeah,
absolutely.
and you have your solid base or your foundation investment. You still have it.
How are you doing internal precipitation on any of this sort of stuff? Instead of
Precipitation,
I didn't
Participation.
say
Rainfall?
Participation.
It's a
participation. I knew what you
ION,
meant,
I had
Joe.
the ION.
I've known Joe for years, and I'm just giving him a hard time.
Yeah. He's the guy
So,
that writes down 4 on his
internal
card when I-
participation. Explain what you mean there to us.
I go out and I bring in a $20,000 commission to the house. Can I direct that toward one of the things that you've been talking about? Or do I have to take all of that? That might be a
Yeah, as a brokerage for Western Investor Network, we do have plans. It's similar to your real job, I'll call it, 401k plan, where depending on the split you are with the company, we, Western Investor Network, will match a portion of that, 5 to 10%, again, depending on the split you are with the company. And so you can start investing in pooling our money together, as we do, and invest in commercial real estate. So it's a great opportunity for young brokers, middle-aged brokers.
Thank you.
I mean, old brokers as well. Really, anybody
Other
wants to
brokers.
put some money into, they've got years to build it up. That's all I'm saying.
Yeah.
Time value of money.
Well, the point normally is in the marketplace, if I don't take money, the IRS may not bother me. If I put it in some other vehicle, it's probably going to have a greater rate of return, and I don't, I'm leveraging the thing, and that's what I've been trying to.
Programs we're talking about, we're doing. So
Yeah, and that's
that program for the brokers that I just mentioned, I think it's pretty unique. I don't know very many brokerage houses. I can't name one really that does that. So
I couldn't find it.
where the broker actually participates back and matches a portion of that. I mean,
Yeah,
it's just
particularly
something
if it's at an increase.
Yeah, and one thing a similar example to answer your question, Joe, is what we're actually doing right now currently with a couple clients, where we're placing 1031 money because we do not want to pay taxes on it, and so they've sold a building and they are putting that into 3 separate investments, and each investment is now a new investment vehicle on how they want to accelerate their returns. For this example, I guess I'll keep it high level. We have one in retail and we have one in cannabis. The one in retail has got a long-term lease and fairly low return. We'll probably be tapping into some of that equity to do some hard money loans to kind of increase that return. The cannabis property over here is it's already a pretty nice return. And so that's got its own risk in itself, but depending on the municipality that you're in, that license could be tied to that property forever. And that business knows they're not going anywhere. And so there may be a premium there. So, just a little.
Okay, thank you.
Any other questions? Well, enjoy the refreshments. I'm going to have some with you, and thanks everybody in
Thank you.
TV
Thanks,
land
guys.
for watching.
Appreciate it.